Most real estate investors completely misunderstand the massive mechanical power of the Section 1031 exchange. They falsely treat this specific tax code as a magical loophole to infinitely delay paying their taxes. This aggressive misunderstanding consistently leads to blown deadlines and shattered capital velocity. To legally weaponize this tax strategy, you must fundamentally master the architecture of replacement. Section 1031 legally allows you to instantly roll your massive capital gains into a new qualifying property. But amateur operators rush to sell their valuable commercial assets without a strict structural plan. They blindly assume that simply holding the cash in a standard bank account protects their tax shield. The federal tax code fundamentally does not care about your personal intentions or your future financial plans. The massive deduction strictly requires using a qualified intermediary before the asset is officially sold. If a single dollar of profit touches your personal bank account, your tax shield is legally worthless. Elite operators flawlessly sequence their logistics to ensure complete separation of operational funds. Furthermore, you do not have to buy the exact same type of real estate to capture this powerful benefit. You can utilize strategic asset class pivoting and still legally defer the entire massive tax burden. This creates a massive wealth-building arbitrage, allowing you to upgrade from residential to commercial. But this powerful financial leverage requires meticulous structural documentation to survive IRS scrutiny. You must strictly identify your target replacement properties within a ruthless 45-day window. If you miss this exact identification deadline by a single minute, you trigger a lethal compliance trap. The IRS will actively monitor the timeline and deploy the ruthless, aggressive mechanism of immediate taxation. They will retroactively invalidate your exchange and force you to recognize the massive capital gains. You must maintain bulletproof, time-stamped identification letters and strict operational compliance data. A simple manual spreadsheet is easily dismissed. You need certified documentation from your intermediary. High-value commercial properties offer massive leverage, but they naturally carry a highly severe audit risk. You must completely separate the corporate investment asset from your personal primary residential home. Remember, this is strictly lawful strategy design and educational framing, never fraudulent tax evasion. There is another critical boundary that inexperienced founders completely overlook during this process. Section 1031 exchanges cannot be legally utilized to purchase commercial assets strictly meant for a rapid flip. The tax shield is strictly limited to properties held for productive use in a trade or business venture. If your property acquisition intent is immediately exposed as a short-term flip, the exchange is voided. You must actively project your exact holding timeline before executing any massive capital deployment. Buying random commercial real estate you do not actually want just to save on taxes destroys efficiency. Stop treating tax code 1031 like a magic eraser and start engineering a calculated acquisition sequence. Verify your closing timeline, secure the optimal intermediary, and ruthlessly enforce your debt metrics. One critical rule amateurs ignore is the strict requirement to replace both your equity and your debt. If your new property carries less mortgage debt than the old one, you trigger immediate taxable boost. The federal government views this specific debt reduction as a direct taxable cash equivalent payout. Smart operators architect their financing to ensure the replacement property absorbs equal or greater debt. You must never allow your hard-earned capital to bleed out through careless, unoptimized mortgage planning. It is entirely possible to consolidate multiple smaller properties into one massive cash-flowing asset. This massive, powerful consolidation strategy permanently reduces your daily operational management headaches. Conversely, you can legally split a single massive asset into multiple diversified regional investments. This structural diversification protects your overall wealth portfolio from isolated economic downturns. Every single maneuver must strictly comply with the unforgiving 180-day closing window. The federal government ever grants absolutely zero extensions for bad weather, lazy bankers, or bad luck. If the final closing is delayed beyond this exact boundary, your entire strategic tax shield collapses. Elite wealth builders dictate the terms of their contracts to absolutely guarantee a flawless execution. They systematically force the sellers to commit to aggressive timelines that protect the 1031 exchange. Amateurs sit back and passively hope the title company finishes the massive paperwork before the deadline. Hope is fundamentally not a legally defensible strategy when you are managing millions in corporate capital. Another aggressive compliance trap involves the physical name placed on the official replacement property title. The exact same tax-paying entity that sold the relinquished property must legally acquire the new asset. If you sell a property under an LLC but attempt to buy the replacement in your own name, you are ruined. This seemingly minor technical oversight instantly vaporizes your entire structural tax deferral shield. Forensic accountants and qualified intermediaries must actively audit your corporate entity structures. You cannot afford a single structural flaw when dealing with seven-figure real estate capital deployments. Cash is the true oxygen of your business operations, so keep it legally protected and constantly moving. When utilized with absolute mechanical precision, the 1031 exchange creates generational family wealth. It allows you to continuously compound your massive equity growth completely tax-free over multiple decades. You simply defer the massive capital gains tax again and again until the ultimate step-up in tax basis. When you eventually pass away, your heirs inherit the massive portfolio entirely free of capital gains. This is the exact difference between a reactive taxpayer and a highly forward-thinking wealth architect. The amateur pays massive taxes today, while the elite operator builds an unstoppable compounding machine. Do not suffocate your own corporate growth just because you are terrified of the complex IRS paperwork. Find a highly aggressive, structurally brilliant tax advisor who specifically understands real estate. Build a dedicated team of legal professionals who live and breathe commercial asset wealth protection. Execute every single transaction with military-grade precision and absolute ruthless timeline compliance. Your massive wealth is built on the precise execution of these complex, highly technical legal frameworks. This level of structural engineering naturally separates the elite true operators from the costly amateurs. Tell me your specific real estate asset class in the comments so we can map out your ultimate exchange. We will structurally analyze your exact debt requirements and legally calculate your compliance limits. Subscribe to Tax Strategies Insider to master the absolute lawful architecture of elite wealth systems.